simple way, um, finding IUL business, right? That doesn't cost you anything. And this is what we're going to talk about today. Annual policy reviews, term to perm, $1 million baby, college funding, 1035 exchanges. If you guys are doing mortgage protection, the third option close. And then a little bit of the Secure Act and legacy building. So let's talk about annual reviews, right? If you guys have been in the insurance business for longer than 1 year, you should be doing annual reviews with all of your clients, right? This is going to future-proof your business. So you hear about those people that have been in the insurance industry for 20 years and they're not buying leads, right? It's because they're using their existing book. They're getting referrals, right? Once you're in this business long enough, you don't have to buy leads. Your marketing cost isn't that high anymore because people from word of mouth are going to kind of share you with their friends and family, right? All the time now people say, hey, Chris, will you talk to my son? Will you talk to my brother? Will you talk to this person? And that's usually on IULs and annuities because I've helped them out, right? But you got to get started somewhere. And annual reviews are free, right? And if you're not doing this right now, you need to start, right? There's CRMs out there. You get a client, you put them in, you put an anniversary date. It'll remind you the next year to reach out to them, right? Also, you should get a letter from the insurance company on these policies. So this is a must if you want to stay in this business for very long, right? And like we said before, this lead cost is zero, right? And there's literally IMOs out there that are paying for this type of book. You guys have your own book. There's an IMO that I used to work with that in their bylaws creates the fact that when you write a policy, that client is not your actual client, they're theirs. And then they go back within 2 years and start talking to your client, right? So you'll be careful with these things you sign also with certain IMOs. Obviously, you do that, you sign that kind of agent agreement, right? When you come along and all of a sudden, everything you write under that IMO is yours. So people are paying for this book of business already. This is yours. It's free to you, right? They already trust you. They already believe in you. They believe in life insurance, right? It's the easiest, simplest thing to do. And with Zoom now, you don't even have to drive there, right? So you just simply, hey, you want to jump on a Zoom call? We need to go over your current term policy or your current final expense policy. Make sure it's still meeting your needs. If you're doing IULs, you definitely have to do annual reviews every year to go over the index strategies, right? So you've got a client that already trusts you, a lead costs that zero, and it's really going to spend 5-10 minutes of your day on a weekly basis. And it's really, once you put this piece of business in here, you see here, I said the second piece of business is always the easiest, right? There's always that, there's already a trust factor. So what we have to do, let's say they came in off a mortgage lead or a final expense lead. Now, really in this one, we've kind of got to ask some questions. So now we're in questions-based selling, right? And we have our TFRA client profile. You generally just have to go through that. So I'm going to call somebody and I'm going to be like, John, hey, I just want to go over, let's say I sold them a mortgage term policy. How are you doing on your mortgage? We have this $200,000 coverage. How are you doing on retirement? All this kind of stuff. And I'm going to ask all these questions. And if I find something in there, right, maybe they just had a kid, right? Hey, have you heard of this concept, right? I'm going to go through all of these different things that this annual review is going to possibly be there. So regardless of our clients, mortgage protection, final expense, health, right, Medicare, turning 65, annuity, IUL, any of them, we want to be talking to them every year, right? And like you kind of see here, if you're not doing it, somebody else is, right? And that somebody is also going to start working at your piece of business you already have with them. Also, they're going to start chipping away at that. It's just the nature of people, unfortunately, right? Even though you might have sold them a good policy, now someone's kind of coming after you. So make sure you're keeping relationships. I'll tell you, when I first got in this business, I started in mortgage protection, and I live in the state of California, in Northern California, outside of Sacramento. And I used to drive, you guys are familiar with California, all the way down to Central Valley, all the way down to almost Bakersfield, Tulare, Visalia, went up to San Jose, Santa Rosa. I used to buy 50 B leads every week, and I'd buy an area, and I'd go there for 2 days, and I would just work for 48 straight hours. And then I come home, write anywhere between, on a bad week, 5 to 20 apps, right? And I just call and go and go. And because I was gone, I was out of town, I wasn't hanging out with friends. I was just working. So it was really good, right? And I got in the mindset. But guess what I didn't do? I didn't do mortgage protection annual reviews every year for someone that lives down in Tulare. That's a 4-hour drive just to get there, right? Should have probably called them, but I was doing this business. I was just constantly churning, right? Constantly going. I left a lot of money on the table. I didn't understand that. All I was doing is buying leads and selling, right? Now, obviously that changed, right, years ago, and I started getting into more advanced life, but I did that also. So I'm not just here, telling you, I was at fault of not doing this. And I had a lot of chargebacks too. I think overall, I probably had about 10 to 15% of that fall off in year one. And then it slowly trickle after that. Usually if it sticks for a year, it's going to stick for the most part. But I had about a 10 to 15% fall off just because I literally would just mail policies to people, right? Hey, I'm going to mail this to you. If you have any questions, give me a call. Because guess what? I'm on to the next, right? I wasn't yet a professional in this industry. I was just a mortgage protection salesperson. Literally, that was it, right? How do I get you the best coverage? All right. If you need anything, call me. That was the extent. Now, that's not a great way of building your business, right? We want to future-proof us in this industry. So what can we do, right? Phone calls, emails, text messages. So if you would have told me 5 years ago that text messages are professional in this industry, I'd say don't do it. However, that's not the case anymore. Sorry, working from home, my dog's kind of a pain in the butt. Text messages are actually the best way to communicate now. If you send a text message, okay, 95% of the time, that person will have read that message within 10 minutes or seen it. They know you're talking to them. If you call and leave a voicemail, you know how many times, think about yourself. Someone calls, you don't recognize the number, or even if you do recognize the number, how often do you not listen to that voicemail? It happens to me all the time. I tell people, hey, if you call me, don't leave a voicemail. Text me right afterwards. I'll get back to you. So text people, hey, and it's simple. Hey, John, just, I wanted to follow up with you. Policy anniversary is coming up here in the 25th. You have 5 minutes. I just want to make sure I'm meeting all of your needs, right? Do you have quick 5-10 minutes for us to jump on a Zoom call? Real easy, but you can call, right? Email. However, I think email's the worst way to communicate with people. And I ignore a ton of emails because now my old personal Yahoo account, I literally get 100 crap emails. I can't seem to stop coming to me, right? So texting is really the way to go. And as someone just pointed out in the chat box, for most people prefer it, right? People will respond to text messages. So however you want to communicate, just communicate. And if it's as easy as sending a text where literally you don't even have to talk to somebody, makes it even easier, right? So like I said, use the profiles that we have. If you get this, we talked about it last week too on the first appointment, it's the same thing for an annual review, right? We just want to gather some information, see how I can best help you. We do help a lot of people with retirement. What if I could get you more money, right? I know, did you have a kid recently? Did you buy a house, right? So look at life triggering events. Did you get a raise? Did you get a new job? Are you contributing to your 401k, right? So instead of asking for referrals, life events happen, people's needs change, right? And a lot of times, since you talk to them, also, hey, by the way, my brother just bought a house, right? So then you start getting referrals, right? These annual reviews, these 5-10 minutes calls are going to lead to more business, right? And it's really important, especially when we talk about IULs and annuities, go over their current retirement plan with them. When do you plan on retiring? So, and I get this all the time. So John, you're 45. You got no money in the bank. You're making $100,000 a year, but you spend it on going out and movies and food and taking your wife and kids. You got no money in your 401k. You're not contributing. You want to retire in 10 years, but you don't have any money yet. Well, so have that conversation. Walk through their strategy with them. Not that I'm saying you're going to do that, but literally people are unrealistic in retirement. 75% of this population, United States, is not on target to retire. 75%. That is a dangerous amount. Social Security is already at risk, right? Unless taxes are raised at some point. So 75% of the population's not putting their own money away. Pension systems are basically gone unless you're a government employee. And Social Security is on life support here in the next 10 years. So what does that look like when the next decades come rolling around? So like we say here, we're looking here to problem solve. And I'm not expecting you guys to understand all this right now. The great thing is you've got us, right? Send in these profiles. I'll help you show where we can put them in a better position, right? And as you start doing this, you're going to start learning, right? Just start doing this exercise. It's like if you played sports, right? Doing certain drills, just help you make you better athletes. Or when you're in school, doing certain study habits make you better in school. That's what this is. This is a habit that is going to make you more money. I promise you. And you're talking about much bigger sales a lot of the times when you get into these type of IULs, annuities. You get into a $500,000 rollover, you just made 25,000. That's a good day for everyone, right? And then, set a second. If you see something there, set a second appointment. Give them, say, hey, I think I may be able to help you out with this. Set a second appointment. Come back in a week. I want to show you some options I may have for you. So, and if you're looking at IULs and you're in annuities, let them know that you help them. You're a specialist in helping people with tax-free income, right? So, when we say annual reviews, a lot of people look at it and go, like, why am I going to do that? If you start doing this, right? If you start eating healthier, if you start going to the gym, are you going to see immediate results the next day? No. 2 weeks later, hey, shirt feels a little bit better today. 2 months later, man, I'm not huffing and puffing when I walk up the stairs anymore. I'm really starting. So it's the same thing. This is an exercise. You've got to exercise this habit in order for it to work. And if you do it, you're going to become professional at this. So doesn't matter what you do. Final expense, MP, Medicare, advanced markets. No, all annual reviews are going to lead to business. Friends and families, referrals. Your people are, hey, this guy's taking the time. They're going to start referring you. You're going to get more life insurance. You're going to find annuities. People now, and I'm kind of in the middle. I'm between the Gen X and I think I'm right on the last year of Gen X. Then you got, I forgot all these Gen. Anyways, but you look at, people now, the younger generation, they're changing jobs all the time. In my generation, I moved around probably 4 or 5 times in 20 years, but the generation now is moving all the time. They're constantly, moving. That what didn't used to be that. So what's an opportunity there? Annuities, right? Because with them moves their retirement strategy, and generally they don't do anything with it. It just sits there. So you're going to find annuities, right? Especially if you're working with people in their 20s and 30s. They're moving around all the time now, always getting better jobs, moving here, some people move out of state because of politics, right? Hey, I moved to Texas. I don't like California, right? It's too blue for me. I need, literally that's happening. People are migrating all over the place. Don't have to work in the office, right? I can work from wherever I want. Ask Idaho, right? Boise, Idaho now costs over $1 million to buy a home in Boise, where 5 years ago was about 400,000, right? So opportunity is all over the place here. So let's talk about markets, right? What are we looking for when we do annual reviews? Well, term to perm, right? They've already bought life insurance from you. You sold them a mortgage term policy. Well, we know they believe in life insurance. Hey, in 20 years, we know we covered you for your mortgage if anything happens to you, but you also have a job, right? What happens if you die? You don't have income replacement for your wife. Also, you got this. So you can literally take them from term policies into permanent policies extremely easy. This is where IMOs, I tell you, are buying this because they want to go back and work your book of business and they want to do it. Okay. Do this with your current clients, right? So once again, use the sheet. right? Let's see how I can better find you. A lot of times we can do this. So when you look at our digital marketing, our IUL, our TFRA leads, 65% of the time when we sell a client, it's no money out of pocket. It's just reallocating money that's going from somewhere and putting it into an IUL, right? So imagine how much life insurance you could sell if it didn't cost your clients anything. I got free insurance. You're already putting this money somewhere. Let me get you insurance for free. Oh, and by the way, it's going to create more income in retirement for you. So once again, we got to find it though. We got to find term to perm, right? So be looking for those people, right? That you've sold term policies to. Now we don't want to go out to the 65-year-olds and do term to perm, but our clients in the 30s, 40s, right around our 50s, right? Let's look at that opportunity, right? $1 million baby. Anybody heard of the $1 million baby concept? It's simply just funding an IUL for a juvenile, and because of just the return and starting early on compounding interest, you're going to have a whopping cash value by that person, by the time that person reaches retirement age. Math, you heard Einstein, compounding interest is the eighth wonder of the world. The sooner you do it, the better. So if you start with a penny and you double it for a month, you have over $10 million, right? So start early. So let's say you're in the final expense business. Did you know grandparents can fund the policy for the grandkids? They can own the policy for their grandkids. Now the parents have to sign off on the application, but how many grandparents do you know that dote on their grandkids? They like them more than their kids generally. So how many, if you're working in the senior market and I'm asking, hey, how's your children? How do you have any grandchildren? Oh, have you ever heard of the $1 million baby concept? Let me walk you through that. $25, $50, $100 a month. Let me show you what that looks like for your kids. Grandparents, and how many grandparents have like 7, 8 grandkids? So now we got 8 policies, right? So if I do one for one, I'm probably going to do it for the others too. I just might have found $800 worth of premium, $400 worth of premium into IULs. Obviously, parents can fund this concept as well, right? Parents, grandparents, obviously the kids are out there working and doing it on their own, but easy concept. I want to put money away for my kids. If you've looked at these illustrations, they kind of sell themselves. You mean I'm going to put $100 away and there's going to be $1 million by the time this kid's 65? Like, holy cow, where do I sign? So I put an example, there's a gal named Felicia out of Georgia that I taught this concept to. Never sold IULs, just started getting into it. She went back into her existing book of business and wrote 6 policies in 2 weeks, all just by going out to her current book, right? It's out there, right? These $1 million, these juvenile policies are, I mean, like I said, sometimes the numbers sell themselves. And we don't want to probably be anywhere below $25, really. There's $10 like moo policies out there, but if you got a 2-week-old baby or 5-year-old, $25 a month. I try to shoot for 100 generally, but some people can't afford it. $50 works well also. So at the end of the day, we probably don't want to go below $25 here, but the more obviously the better. So college funding. You heard this 529 plans where most people put their money in, right? So just like the $1 million baby concept, it's still a juvenile IUL. But now the purpose of what we're doing, right? All we're doing is changing the narrative. Are we still putting money into life insurance? Yes, but the market is college funding. Why should you put money into this? To save money for your kids. So same thing, still funding an IUL. They still have the $1 million baby concept also. So hey, by the way, when you're done with college, you still have a policy in place that your child now can start dumping money into now that they're of working age. And by the time they get to 65, oh, by the way, you've started them early. Same thing, grandparents, parents, both contributing. One of the biggest advantages of an IUL versus a 529 plan is that you don't have to put this on your financial aid applications. You do on 529s. You're judged down. So essentially this money for this child cannot be seen from the student loan departments, the financial aid. It's been a long time since I went to school, so I don't know exactly what everyone's doing now, but IULs are able to kind of hide your money from these people that are looking. if you make over a certain amount of money, you can't even get financial aid from the state, from the university, right? So great opportunity there, a great selling point of why you put money into an IUL. So when we talk about college funding, important things to understand when using an IUL for college funding. And there's a reverse ways of doing this. If you have very wealthy family and you have large sums of money, we can actually dump it in. There's ways to do this with LSW that are pretty unique. So if you run into that, but generally the age of the kid matters, right? If they're putting in $100 and they're 15 years old, is 3 years of putting away $1,200 really going to help them? Probably not. So you want to set expectations here. And a lot of times writing it on the parent, because we can dump more money in, is effective as well. But keep in mind, everything's a case-by-case basis. So depending on your particular client, we're going to look at what's the best way to go. And there are ways when an agent gets a little closer to college age, and if they have a lot of money and they want to dump it in, there was ways to do that. So keep that in mind. 1035 exchanges. Okay, so you guys know what a 1035 exchange is. Simply taking life insurance cash value and putting it from one policy into the other. This is the greatest time in your career that you're ever going to see this opportunity right now. Two things have happened. One, there's been 2 rate reductions on the cost of insurance in the last 11 years, or really, well, last 14 years, 2010 and 2020, right? Cost of insurance dropped. So whole life insurance and IULs have been extremely popular in the last 2 decades. I just ran into a Transamerica policy that's 14 years old. There were 10, literally yesterday I went over with the agent. One, the agent was and I don't mean to bash on these people, but they just always seem to come across with terrible written IULs. It's a World Financial Group Transamerica policy, and there's 5 times too much life insurance on this plan. So where this client should have about $50,000 in cash value, they've got 21, but they're still young. They're still 45. So they started when they were in their early 30s, but their death benefit is $750,000 where it should have been 130. And so, but it's been 14 years. Guess what? We get to move. It's a husband and wife also. So we're going to 1035. I think it's 22 for him and 19 for her. We're going to exchange all that money, reallocate the money that they're already putting in, and dump in about another 450 on top of it. The agent's going to make about 25, 30 grand on these policies, and she's helping her client. It's a good thing they found her first, because eventually these policies were going to run into trouble later on, because the COI was going to get a little out of control. So 2 rate reductions in cost of insurance, right? Policies now are cheaper. And 7702 guidelines changed in 2002, right? If you guys remember, if you've heard me talk about essentially when COVID hit, Congress passed the CARES Act. And now if we want, let's say we want to dump in $100,000 a year into a life insurance plan, now we need half the insurance than before. So essentially, to qualify for life insurance is a lot less. So now our fees are a lot less. Insurance in this space is on sale, right? Oh, I know you had the old IUL 14 years ago. Do you have the new insurance? Think about a car analogy. What was your first car? And I'll ask people that. Well, me, I had a 1988 Honda Accord. Guess what it didn't have? It didn't have a touchscreen. It didn't have the ability for me to plug in my iPhone. Couldn't connect to the World Wide Web, right? The new cars do. Well, the same thing with insurance, right? Do you have the new insurance that's out there? Any permanent policy can be 1035, whole life, universal life, IUL, VUL, right? This is the greatest opportunity for 1035 exchanges. I think it is predicted in the next, I think in 2029, that the cost of insurance may go up. And that had to do with the opioid epidemic that's been going on in this country. People are dying earlier. So there's a possibility for the first time in like a century that the stats will say people are dying earlier. I don't know that's going to happen yet. Obviously, there's about another 5 or 6 years of statistics that need to come out. But you've got the 7702 guidelines, you've got the cost of insurance, and you've got the fact that permanent life insurance has been extremely popular over the last decade. It's important to understand what happens when you have permanent life insurance, like we're doing with these clients with the Transamerica policy. What is the purpose of this policy? Why did you buy it? You bought this policy for retirement, for tax savings. Okay, then we point out the flaws, right? Man, you got way too much insurance. You should have $440,000 in here versus your 21, right? So make sure you find out the purpose of why they bought the policy. Oh, we bought it for death benefit, right? Well, then that conversation is completely different. Or I bought it for long-term care. So find out why, what is the purpose of what they're doing. And know that generally, and this is unfortunate, it gives a YouTube characters IUL fodder. There's a lot of guys, people, agents that don't know what they're doing, right? And then you get, like I said, the YouTube characters out there talking about how IULs are going to blow up and all this kind of stuff. That's a conversation for another day. But because people don't know what they're doing, unfortunately, it does lead to that sometimes. So, but we can put our clients in much better position. Now, 401k reallocation and tax-free retirement, right? Are you putting money into a 401k? Is your company matching? How much do they match, right? We want to find out where the money is going. I've worked with this, before I started consulting for Heartland, I had a company and we worked with state employees here in California. We had about 20 agents and we would go out to the actual premises. And people in the state of California had the best pension plan in the world. It's the second biggest pension plan besides the federal government. It is trillions of dollars in this pension plan. So you know what they don't do? They also have access to a 457 and a 401k, but the state of California does not match those funds. So we would go there, sit down, ask them, hey, how much money are you putting in your 457 and 401k? Hey, if I could show you a way to create that tax-free, have a tax-free supplemental retirement plan without you having to come out with any other money and give you more money in retirement for those same dollars, that's something you'd be interested in? Perfect. Start the conversation, right? So find out 401k reallocation. When we break down the numbers, money above the match is where our wheel is, right? I'm not going to take away free money. So if someone's, and the way we look at it, let's say they make $100,000 a year, and they say they contribute 10%. So that means they're putting in $10,000 a year of their income. Now I'm going to ask them, well, what is the company matching? And generally it's around 3 to 5% right now, tops. Dollar for dollar, let's say it's 3%. And that's kind of where most companies are right now. So that means our client's putting in 10, the company, the employer is matching 3. So now what do I have? I've got 7,000 to play with, because I'm gonna keep on putting money in there. That's free money. You're coming. You want to keep taking advantage of that. But let me show you what I can do with the money that company is not matching and get a higher return. Right? Like we said, do the client profile. We know government employees are getting matched, federal employees, state employees. Some federal employees now are moving off the pension into a TSP. So you got to find out if they do have a pension. But it's simple, right? How much are you contributing? Let me show you another option. Do you think taxes are going to go up? Okay, you realize in the 457 and the 401k you're putting money into, all of this money is going to be taxed. Let me show you how those numbers work. Our software system, Retirement Brain, you guys have not looked at retirement, you guys have free access because you guys work with Safe Haven. You have access to Retirement Brain that we can break down the difference in taxes on these two plans. So mortgage protection, right? If you're doing this, third option close. You got term with ROP, and the mortgage accelerator. And you can do this a lot of times with just money they're already putting away. So we all know mortgage protection is highly competitive, right? So, I mean, when you buy a house, you're getting about 20 mailers. So, I mean, and so we know there's a lot of agencies, there's a lot of agents out there trying to fish in the same pond as you. And most of them don't offer this. Some of them do. But most mortgage protection agents don't understand this well enough, and they're scared to take away possible closes because they don't want to change what they do, right? Learn this. You got living benefits, you got retirement strategy, pay off your mortgage earlier, right? There's all these reasons why you would do this. Your average mortgage case, like I said, I know this because I did it, right? I did it for years. Right? Average mortgage case, the term and term with RRPs, right around $100 a comp, right? AP somewhere in that bucket. Your average IUL is going to be over 3,000, and you're going to get residuals for 10 years. Not full comp residuals, but you're going to get residuals for 10 years. So you start getting those late dollars. And then what is your client value, right? Not every client mortgage protection is going to be an IUL, but if you start adding this in, just like we said, when you start exercising, eventually you start feeling better, right? Eventually you're going to start getting this. You just have to follow the process. And I know I see a lot of things in the chat box. We'll get to these here in a second. We're almost done. And then high net worth clients. Okay. Number one, we got premium financing options. You got access to traditional premium financing. You guys have access to Kaizen, which is a little bit more of a low level premium financing. But you guys have access. I will go point of sale with you. I have a team that manages all the loans, manages all the trust. We will get on with you if you have the right clientele. You got to do the homework first to find out what their financials are. But on those cases, we will go point of sale with you to help you close this book. Okay. The Secure Act. So if you guys remember, about 2-3 years ago, about 3 years ago now, they changed the way inherited IRAs are paid out. Okay. So now if you get an IRA from a parent, you have to take all of the income in 10 years and pay your taxes. Where before it used to be called a stretch IRA, you could stretch it out your entire life. Now Uncle Sam is getting a little greedy. He says, I want my money now. You got to pay me in 10 years. So you can use this with your clients to fund if they have leave on money that's stuck in an IRA, we can start funding that with a life insurance plan. Also, there was a tax benefit back in 2017, I believe, is when they changed the tax code. That is sunsetting in 2025. And so what that means is your high net worth individuals, your people over 5 million net worth, somewhere in that ballpark. And it is going to matter who wins the election in 2024, depending on if this tax law sunsets or not. But if it sunsets, now there's going to be tax burden for legacy planning. And if that tax burden or that tax benefit goes away, that's an opportunity for you as life insurance. Because now if you're within a certain threshold, which is going to drop it, that is going to be now what they call the death tax, right? Essentially, the federal government is going to want some of those. But there's ways to legacy plan to start paying that money now, right, into life insurance, so that will be tax-free to your client. So that's out there, right? If you finding these high net worth clients, bring us in. So guys, that's all I had. I know we have a few questions here. Let's go all the way back to the top. Oh, here we go. Okay, let's go a couple jokes. 65-year-olds do have permanent sometimes. Yeah. So everything's going to be we go back and 65-year-olds generally, when they're getting insurance from term, they're looking for life insurance protection, right? So there are opportunities there for older people, but a lot of times we're going to look at GULs, maybe whole life policies. IULs kind of run out of permanent life insurance. Maybe they want long-term care, right? Depending on their money. But yes, we still can write permanent life policies. I do a lot of GUL with Anico and North American, where I'm looking for a straight low cost permanent policy that's guaranteed, right? So David, a 529 plan, if the student or potential student does not go to college, all of that money becomes taxable, right? So there is a tax obligation that happens in 529 plans. In IULs, they don't. So if the parents are planning on going to college and they don't, yes, it creates a taxable event at that time.
But like after college, do they have to dispose of the plan, or is that something they have an opportunity to carry on with?
I don't have the exact answer for that. They need to exhaust the funds completely if they don't want to be taxed on it. But if they don't, I think it can become, the parents have the right. There's a couple options there. I've yet to run into it myself personally, so I don't have an exact answer for you. But if they don't use it, it's taxed. I think the parents can take it back. I'm not sure if they can gift it to the kid or not. I'm not 100% sure. I think they may be able to, but I'll find options for you before we do our next call, and I'll follow up with you on that question.
And were 529 plans pre-tax or after tax, and then they're taxed again?
Yeah, well, I think yes. If you don't go, there's taxable, but you can defer taxes. There's a little bit of a tax break when you're doing that. So I'm not a tax professional on those plans. So I don't know all the tax rules that surround them, but there are some tax favorabilities to putting money in. But there's also, just like everything with the tax favorability in the beginning, there's tax consequences at the end, right? Yeah. And so I always, whenever I talk to a client about that, I say, hey, I don't have the 3-letter word CPA after my name, so I'm not qualified to give you advice on these. Talk to your tax person, your accountant, your CPA. They will advise you a little bit better than I. But here's the general rules, so I'll tell them. LSW is North American, just for reference. Okay. No, LSW North American. LSW is National Life Group. Yes, North American is North American. So those are two different companies. Yes. Okay. CalPERS, CalSTRS. I worked mainly with CalPERS. I think if that's the question is, so people that had CalPERS. I was more in the sheriff's, correctional officer arena. So the I didn't do a lot with teachers. I did a lot with law enforcement, corrections here in the state of California, which, if you guys know anything here about California, essentially, if you're a law enforcement officer, corrections, CHP, sheriff, they all make about $140,000 to $200,000 a year. Their medical bills are zero when they retire, and they make about 95 to 90%. It's just actually more money when you take away all the money they're putting away when they're working. They retire making more money in retirement, no medical bills for them or their wife. It's one of the reasons why California is constantly having to raise taxes. The biggest pension system in the world, and it's funds like crazy. So, do you know if these states that are going to require LTC are going to allow a rider? Okay, so I don't know everything with this, but in the state of Washington that did requirement did allow life insurance for this. Yes. So each state's going to be different. But it was a huge opportunity. I had a agent in Washington. That's all they did for a year, because they also gave a window that you had to have a policy by this. Okay, and in the state of Washington, they did allow that.
Is there something special you have to do to like build up the long-term care, or is it just simple like a button that you click and you're adding a long-term care rider?
Well, every policy is different. So sometimes the living benefits in a life insurance policy, like in the state of Washington, that was okay to use. There's actual long-term care riders, like Nationwide is really good at it. To actually a true long-term care rider, right? Where there's, hey, this is a benefit if you need to go in here. There's another company that uses whole life insurance. It's a true long-term care policy. So it depends on the state regulation on if what's going to work. So I don't know what the language is in all these different states. It's going to be, every state's going to be different that requires it. And then generally you're going to find that, because not everybody can afford long-term care, right? That's what will happen. The problem in Washington is people are like, well, I can buy the long-term care policy, or I can just pay the fine, right? It's cheaper to pay the fine. So generally you're going to find a cheap form of long-term care for people not to pay the fine. Now, is that generally an IUL with living benefits, or is that a true long-term care policy is out of control expensive? So most people can't afford it. There's long-term care companies, almost all of them went out of business in the late 2000s, because guess what happens? 25% of the people after the age of 65 need long-term care. Insurance companies weren't built for that, right? And then you got the baby boomer. You got 10,000 people turning 65 every day for the last 15 years. Well, bankrupted all these insurance companies. So long-term care, true long-term care, is extremely expensive, and there's not that many people that offer it. So it's going to be, we'll see what happens when these states come out. There was a ton of problems in the state of Washington when this got rolled out. They did this too quickly, and nobody was prepared for it. Even the insurance companies really weren't prepared for it. A lot of insurance companies pulled out. So we're out of this, right? So like Moo stopped taking Washington policies. They're like, we are done with the state of Washington policy until this is over with, and then they went back in. So we'll see how that goes. Carlos, do you have any podcasts or book recommend on advanced markets? I have the Retirement Miracle book. You can shoot me an email. I can send that over to you. Podcasts. I'm not. I don't know. I'm not sure on podcasts. But if you want to read a great book, The Retirement Miracle, there's Tax-Free Retirement. The Power of Zero is a good book. But podcasts, I'm sure they're out there. I'm not a podcaster yet, so not quite sure.
Thank you, bro. Appreciate it.
Yeah. But if the Retirement Miracle, I can literally email you a PDF. Just shoot me an email when you get a chance, and I'll email it back to you.
Awesome. Thank you, bro.
Yeah. All right, guys. I'm not seeing anything else.
I have a quick question.
Sure.
And it's like not directly IUL related, but in terms of people that are actually retiring, like how often would you end up adding a long-term care rider into somebody's like annuity?
Well, it depends. A lot of my annuities are accumulation focused, so I don't sell a lot of income products. Where that's generally where the long-term care strategies are. I sell more of the accumulation products. So like for SILAC, like the Denali, the Teton. For like F&G, I use the Accumulator Plus, the Power Accumulator. And this is where I talk about marriage versus dating with insurance products. I always want to give my clients the ability to do, when the market changes, them to have flexibility. So if they need money, like, hey, I know that this income rider is going to solve your income need for the rest of your life, I'll show that to them, right? I need $5,000 a month. This is going to give them, $60,000 a year. Hey, this will do it. It's guaranteed. You never have to worry about it. And they're now married to that product, right? For the rest of their life. It'd be stupid for them to leave, because in an income rider, there's fees, and you're generally trying to outlive the actuaries based on the numbers that the insurance company goes, right? It's not leave on money. But accumulation products is just to accumulate or grow, allow them to pull money out as they want. That's why I like F&G, because they can pull 10% a year out, right, without any penalty. Versus SILAC, it's 5%. That's why I write that product a little bit more. But they're not married to that product forever. So in 10 years from now, some new product comes out, they still have the ability to do other things, right? So it just depends on your clients. And that's why whenever somebody retires, I'm going to look at it. If they want long-term care or they want protection from it, I'm going to put them into probably an annuity. There's another product out there too that's pretty good from a company called One America. That is a true long-term care policy that's affordable. So if they want long-term care, I'm giving it. If they just want a little long-term care support, I'll put it into a company that has an indemnity rider and do it that way. But I don't do that often, generally. I know it's kind of a long-winded answer.
That was informative, though. Thank you.
And that's just me. That's just how I do things. I tend to not want to have somebody stuck, and I don't say stuck, but like I said, married to a product, because you never know what's going to happen in 10, 15 years. Life changes, right? That's just, but income riders do solve a lot of problems for people that need the guaranteed income. So my clientele generally isn't that, though.
Is there ever any scenario where somebody be in their late 50s, early 60s, they retire, and let's just say they have like $500,000, $600,000, $800,000? Is there any example there that you'd ever use an IUL over an annuity, or would just strictly use an annuity in that case?
Not an IUL. So yeah, remember, an IUL is more of a accumulation product during your working years. So if you're getting towards retirement age, and there's companies out there that do what's called IRA rescue. Someone will get close to retirement, and they'll fund an IUL from qualified money. However, I think you guys have heard me this before. It's a great way to be a target of an attorney by doing that. You're putting secured money, qualified securities, and you don't have a securities license, and you advise them to put money into life insurance. And God forbid that life insurance policy doesn't perform, you're going to get sued. And attorneys are out there looking for that. I mean, always. So it was a market, that type of plan was marketed by a lot of IMOs called IRA rescue, right? Let's save your IRA. Great way to find yourself in a letter. Hey, Chris Miller, you know all those policies that you did, putting qualified money, we'd like to have a deposition. Right. So I stay away from that kind of stuff. I think once somebody's gone to retirement age, I go to annuities rather than IUL 100% of the time. I don't do IRA rescue. Now, if someone's in their 50s and they've got, 10 years to retirement and they want to unqualify some of that money, I'll do what's called a 72T, which is 72T will allow them to take equal and consistent distributions for 5 years or till they're 59 and a half, whichever is longer. And we can then pay taxes on it and put it into an IUL. But I'm doing that for at least 10 years. And I'll do it that way. And I have them get their CPA involved.
Yeah, absolutely. If somebody was anticipating a market crash, and let's say they have $500,000 in their 401k and they're making $100,000 a year, they were concerned about the market crashing. Would you be jeopardizing using your E&O insurance if you told somebody, well, hey, you could just retire to be able to get your 401k out of there in the event there's no like in-service non-hardship transfer?
Well, they can just change their allocation. So the 401k you can put into a fixed account.
But if they don't allow an in-service non-hardship transfer and you have to get fired or retire to be able to take your money out, I mean, to like put it into an annuity, is that something you can tell somebody like, hey, if you retire?
I mean, there's one thing. I knew what the market was going to crash, and I could foresee that. I've been thinking the market was going to crash since 2016, and the market hasn't yet, right? We have not had a market correction since 2008, right? So now we're what? We're almost 15 something years.
We're due.
We're due, right? So I've been talking, hey, the market has to correct itself at some point. I've been saying that since 2016. Now, if I knew, this is where I would tell you, you got to be careful. If I knew the market was going to crash, I could tell my client to get out of there. I would not be on this call with you right now. I would be on my yacht in the Mediterranean because I can predict the market, right? So one, you don't have the license to do that. Two, you're going to be wrong 99.9% of the time. I would advise my client, hey, if you do think the market is going to correct and you are worried about that, look at the options in your 401k. There's ways to mitigate your risk and get more into a fixed account, because in every 401k you can pull out. You don't have to get large cap, mid cap, blended, most 401ks, right? But any decent one that a company is going to use. And then there's always going to be a fixed option, generally fixed income, cash. You can put cash. A 401k can be cash. You don't get any return, but you don't also affect the losses. So I would advise them to do that versus involving myself in that.
Yeah. And I was just basing that on like the client's philosophy. There's a lot of skeptics and people that are scarce out there, but I know the last crash was in 08, but we've had a couple corrections since then, right?
Not true corrections. I mean, COVID, the market dropped 30%, but by the end of the year, it was up 20.
Okay.
That's a lot. I mean, last year, so 2022, we lost 20%, but that's a dip. That's not a correction.
Correction if it's a loss over 20% or 20 or under that year, but a crash is over 20%. Is that correct?
The last two corrections were the .com bubble. So 2000 and 2002 is 3 straight years, and that loss was anywhere from 40 to 60%, depending on where you were. Right? That's a correction. Then it was 2008. 2008 was 40, 50% loss in 1 year. Those are considered market corrections. We have not yet. COVID dropped like this, and it was looking like it was going to be a market correction, but it immediately rebounded. And then last year, I mean, right now the market's going crazy the last 2 days, but 2022, we had around, somewhere depending 19, 20% loss, depending on what index and market you're looking at. But that's going to have to continue again this year, which it hasn't. The market's returned. And it's got to be consistent. Generally, it's 30% or higher, and it's multiple years or one big year.
Thank you for clearing that up.
Yeah.
Don't talk. See, I fixed it.
All right. Well, hey guys, I appreciate your time.
Thank you, Chris.
Yeah, you guys, that's my number. That's my cell phone. So you guys have any questions, you need anything from me, reach out to me anytime. Appreciate it.